Good day. Ira Epstein of Linn and Associates with your SPDR ETF wrap-up, and I'm really early today, which is great. I've got some time. I can get this done finally much earlier. And this is for Wednesday, and we are at the 3rd of February, 2021. Well, probably pushing 3:30 in the afternoon. An up day in a number of markets. We got a few down, like the QQQ, the TLT, but overall it was more of an up day than a down day in the marketplace. As we take a look at PAVE, as I told you the other day, the market has now filled this gap, so now the question is what next? Well, what we're seeing is the Biden administration is being somewhat flexible. They want the $1,400 payment to go out. They'll have some flexibility on who. It won't be just helicopter money. It's who. As for the rest of the program, it seems to me they're ready to go for it, and we'll see what happens. That's beneficial to PAVE. Why? Infrastructure spending after this. You're even hearing Treasury Secretary Yellen saying, go big, don't go small. There's less risk if you go big to the economy. So that's a very interesting statement from her. Interesting also how she brought together a group of regulators today talking about GME and AMC and all the others. Folks, let the buyer beware. It's that simple. It's great that the millennials and this other generation are coming to the market and trading. They have a lot to learn. If we're so easy to make money, why would we all be here? They have a lot to learn, but getting them into the marketplace, great. Stopping them from buying too high, Social media ain't going away. So I don't know what they'll come up with, but we'll find out. In any case, as you look at the market, you can see how it's been coming back up, and you're out of the downtrend. I mentioned that to you yesterday, saying it again today very clearly. You can see that if it wants to rally up, the resistance point would be the 18-day moving average of closes. I consider the 18-day average the line in the sand. It's the neutral part, the DMZ between north and south. It is the line that you look at, and from that line, a lot of things happen. So when you're down under it to get a good rally, yeah, you can get up to that number, and that's where the market often finds some resistance. As for support, the market had gone down to the lower Bollinger Band. These are the upper bands. They don't run parallel. They're an algorithm designed to keep the market within them 95% of the time. Why not 100% of the time? Because then you'd never hit the bands. And you need a number to be hit so that professional money has a zone. They go, okay, I may be wrong. It can go a little bit beyond that, but I'm in the zone that I want to take some money off the table because it's not going to keep going under that more than 5%, or you can change it and make it not going to go 4 or 3, whatever your number is. The preferred way is 95% of the time within the bands. In terms of momentum, I mentioned to you the other day, momentum was turning up. Momentum often leads price action, and now momentum's come up enough where it is still in overbought territory but improving. Any reading, in my opinion, of a slow stochastic under 30 is an oversold condition. 28.6 certainly fits into that. In SMH, battleground, we can see it. It's the what? It's the 18-day average of closes. I expect that to be this way for a little bit. Back and forth action. You're in an uptrend. Lost its way today in terms of momentum, or bias, I should say, because you're under the 18-day average, and momentum has just flattened out again. I don't see any sell signal that can come out of this. Period, even if you were to get under these lows. And I can see reason for the continuation of the buy soon. But I think it's going to consolidate around that 18-day average. In XLI, the industrial sector, momentum is turned up. You're out of an oversold condition. If we come back a day, you can see just yesterday you were still oversold with a 26.99 reading. Today you're out of that. You got up high enough yesterday to end the downtrend. You have a lower low, higher high. Let's assume it rallies. Support back up at, resistance, 88.16. I don't see support in the market if you just let go to the downside until these numbers get back to. I'm not bearish. I'm just no reason to be bullish yet. In the energy sector, you went right up to my line in the sand, the 18-day average, and that's where the market stalled. Today's high, 41.85. The 18-day average, 41.84, and you just ran out of your momentum. In the process, you ended the downtrend. So this leg to the downside ended, and if I come back here, because you had lower highs, lower lows, and you took out that 41.16. You've broken that pattern. It had hit the lower Bollinger Band. Regular viewers here know that the first time you hit a Bollinger Band, you will hear me say over and over, unless I've got a fever or something, that is where I think the pros are going to take some money off the table. And now you've gotten back to the DMZ zone, that line in the sand. We'll have to see what it wants to do. No trend working out of an oversold condition. QQQ. Didn't quite make it to the upper Bollinger Band, running out of some of the upside momentum. Bias is still up, but you're in an overbought area. Other than earnings, which might kick something one way or the other, this market just looks to me like it's had its bounce off the 18-day average and it has more work to do. In the emerging market ETF, as much as traders want to be bullish this, I'm just not seeing it yet. You still have the lower high, the lower low. This high did not take out that. You'd actually get fresh selling in the market if you take out today's low. That low, by the way, is 70, what is that going to be? 73.81, and don't take out the 74.21 first. So that would be an interesting ploy, and that could kick you back down here. Let's see what it does. I'd like to see it take out 74.24, negate this downtrend. We already bounced where I thought we would bounce from right here. You extended it, but you still got your bounce. Want to see a play here. I ultimately want to be in the bull camp on this. The longer term charts are fine. It's the daily charts that are the problem. In the gold market, I am not fine in this. You had a bearish crossover now. If we come back to yesterday, you had the 18-day average of closes still above the 200-day. Now today you've got your bearish crossover. Wouldn't surprise me if we go down and challenge the lower Bollinger Band again. All this market has been able to do is fight a battle at that 200-day and 18-day. It walked away from it yesterday. There might be further downside in it tomorrow. As we come into the gold miners, if gold's no good, how good can the miners be? Well, they can't be very good. They're not going to go up without the gold, in my opinion. Higher high, lower low, no trend. Where did you rally to? All you did, remember that line in the sand you hear me talking about? That is the number. You went there, stalled out, coming back down from there. Not a trend though. TLT. Still in a bear trend, but you're now at the lower Bollinger Band. When you get there, I think the pros take money off the table, period. I don't care if it goes low or not. You can drop a stop, for example, keep a stop over today's high, but I think the pros took money off when it hit that lower band. That band number was 149.68, the low 149.58, and you closed literally right on it. I'm comfortable telling you flat. What about FXE? I think you're going to find that you got big support that's going to come in between the Bollinger Band bottom and the 100-day average. You're oversold. You've had a prolonged break in the marketplace. We know why this market is staying weak. It has to do with the COVID situation. However, we still believe that as that gets passed around in Europe, a little later, that this will be one of the better trades against the dollar. I have not lost sight of that. Although in the dollar index, I must tell you, for those of you that watch my commodity tape, my financial market tapes, you'll find out that we've got a price count that is actually calling for the dollar even higher until the most recent lows are taken out. It was activated today. If you don't know what price counts are, you might want to get our free offerings on our website with our market research from the Linn Group. We send out daily price counts. So you get a special chart telling you the counts where a market might be headed if a trend enacts and continues to go. So interesting point. For those of you that are ETF traders, you know, at 5 8:40 in the morning, I put out a futures video or start recording it. And about 8:30, 8:40 in the morning, I start recording a SPDR ETF video. The reason I do that, I want the SPDRs and ETFs to open. The reason I can do the futures that early, they open at 5 at night. So I'm already 12 hours into the trading session when I do it in the morning. I cover over 40 charts now on my SPDR ETF, and I do rotate them. The groups, from the currencies to the SPDRs, the others, the indices, the metal markets. You can pause here, see some of them. There's more charts than this now. As an example, we're looking at PAVE here. You don't see PAVE on the list, all right? I keep adding to the list, and I think that's really important. So I start the day off with telling you the news of the day. What were the U.S. reports so far? What's going on in Europe? What should traders be looking at? Then I'm going to walk you into the chart action and try to walk you through all this. How do you find out about it? You go to our website, www.iraepstein.com, under the word research. It's all there for you. In the meantime, I'm Ira Epstein. You have a great trading day.